Good evening and welcome to Money Moves here on Tonight with Tim Modise. And as always, we talk about your finances, the state of the economy. And remember, Money Moves is brought to you by 274 investment managers. We live investments, and that's what they tell you at investment managers. You can get in touch with them. Their number is 011 442 2464, 442-2464, or you can send an email to info@274.com, 27four.com. Now, Nadir Thokan is back with us, and our discussion tonight is the roadshow that the Minister of Finance is embarking upon. And of course, we've all been talking about the ratings downgrade as if we all know what we're talking about. But I think we need to start there and explain exactly who does the downgrading and why is it important that the nation focuses on this discussion.
Okay, well, Tim, first of all, the ratings are done by what we call ratings agencies, and there's three major ratings agencies in the world which rate and rank the credit quality or the credit worthiness of various sovereign and corporate debts. That's Standard & Poor's, Moody's ratings agencies, and Fitch ratings agencies. So all three ratings agencies currently have us on one notch above junk status, or we're still investment grade, but if we get downgraded one more notch, we'll be on junk status. And they all have us on negative watch, meaning that the ratings agencies are concerned about South Africa's credit rating at the moment, our credit worthiness, the amount of debt we've taken on, the amount of revenue we can raise in order to repay that debt over the longer term, and do we have a credible and a sustainable plan to derive enough revenue to repay the amount of debt we've taken on. So it's a very, very critical measure because, at the end of the day, South Africa collects somewhere in the region of 1.3 trillion rand in taxes every year, and we spend, a fair amount significantly more than that. And the difference has to be funded by raising debt from international bond investors or investors in bonds. So what happens is that the South African government issues debt, and external investors, be it fund managers, be it pension funds, be it retail investors even, can buy these instruments which pay a fixed coupon usually twice a year. And they usually have a tenure of anywhere between 5 and 30 years, depending where the government issues the debt upon. So the reason why our credit rating is so important is because it's a major determinant of what rate of interest we pay on that money that government borrows from the investment community and from the general public. Now, the higher the interest rate that we pay, the bigger a portion of the overall budget which needs to go to debt servicing costs. So just a couple of weeks ago, Minister Pravin Gordhan delivered his budget in Parliament, and we know that around 147 billion rand goes to debt servicing costs every year. That's about roughly 10% of the South African budget just goes towards debt servicing costs. Now, if we downgrade it to junk status and we have to pay more interest on our debt, the interest rate goes up. That's a bigger portion of the budget which has to go towards debt servicing costs, and a lower proportion of the budget which can go towards productive spending, be it infrastructure spend to boost long-term economic growth, be it social services in terms of grants and addressing the long-standing problems of inequality in the South African economy. A smaller portion of the budget can go to that if we have to pay more interest on our debt, and that's why it's so critical that we maintain our investment grade credit rating so that we don't have to pay exorbitant amounts of money to borrow money from the international bond market.
I do understand that, and that's at national level, at government level, those would be the implications. Now, for individual citizens, how are we affected by a downgrade of that nature if South Africa were to be rated junk status?
So there's a couple of ways we'll be impacted, Tim. So it's going to affect the government ledger in two ways, which affects the public. One, government's either got to tighten their belt and spend less money, which obviously has a knock-on impact in terms of economic growth, knock-on job creation, smaller pension benefits, etc. And the second way it affects citizens is that, in order to meet the debt service costs or the higher debt service costs, government may need to increase taxes to raise more revenues. And we know nobody likes paying more taxes. There's a lot of hurraying about the fact that the marginal income tax rate didn't go up and VAT didn't go up. But if our debt service costs start to spiral a little bit, we may need to resort to increasing those taxes so the government can raise more revenue. So the bottom line is that slower economic growth, because government won't be able to put money towards more productive avenues of spending, or, we're going to have less money in our pocket at the end of the month because we've got to pay more taxes, either through VAT or marginal income tax.
So that's where the risk is. And I noticed that there's also talk of downgrades when it comes to companies. For instance, Anglo-American has been downgraded itself. So is it something of concern to Anglo-American by itself, or does it tell us something about the South African economy as well?
Well, absolutely. We know that Anglo-American is a global mining conglomerate now. Obviously, South Africa is a very integral part of its earnings. It contributes, in excess of 50% of Anglo-American's earnings still comes from South Africa. So we know that lower commodity prices affects the amount of revenue that they can raise. So, bond investors say, well, Anglo-American is less likely to repay the amount of money they've borrowed from the international bond markets. Therefore, they become junk status. But yes, to your point, it does affect South African corporates quite drastically, because the corporate credit rating obviously leverages off the broader sovereign credit rating. And if the broader sovereign or government credit rating gets downgraded, corporates are going to be impacted by that, meaning that corporates' cost of servicing debt is going to go up. A bigger portion of their profits, or a bigger portion of their revenue, should I say, is going to go towards paying for interest costs. A smaller portion of their revenue is going to filter down into profits, into earnings, into dividends attributable to shareholders. So, if we got a company that's highly leveraged, as a lot of the mining companies are, because it's obviously very costly to build mines and you've got to raise a lot of revenue to sink a shaft. If we look at Implats, they estimate somewhere in the region of 3.5 to 4 billion rand to sink one platinum shaft in one of their mines. So those are very leveraged companies, because they need to raise a lot of debt in order to invest in their mines. And obviously, if you're raising all this debt, but your revenues are declining in a lower commodity price environment, or you've got to pay more of your profits away to servicing interest, there's going to be less profits attributable to shareholders. Lower earnings mean share prices are not going to move up as aggressively as what people may hope. So investors in the stock market, either directly or indirectly through their pension fund savings, are going to suffer the consequences of structurally lower returns. So I think for the time being, on a very macroeconomic top-down level, it's fairly critical that we avert being downgraded to junk status and having higher borrowing costs, either at the sovereign or the corporate.
Now, the story around Absa and Barclays disinvesting from Absa or reducing their investments there, what is the implication thereof? This is another sector now, right? And I mean, the financial sector. Yeah.
Look, Tim, I think it's important to put these things into consideration. We can't consider things in isolation. We tend to get carried away living in South Africa, being exposed to how slowly our economy is growing. We tend to be placing too much weight on that. We have to remember at the end of the day that the parent company, Barclays PLC, listed in London, predominantly a developed markets banking operation, have severe capital constraints. We know that ever since the end of the global financial crisis, there's been a lot of pressure on banks to raise their capital levels and to ensure that they're very well capitalized. Now, it's a preemptive move by Barclays. We've seen across the European Union, there's been somewhat of a crisis in the banks over the last couple of weeks and months, where we have negative interest rates preventing these banks from having sufficient capital in order to pass these Basel III requirement tests. So, Barclays looks at Africa, looks at South Africa and says, well, the economy is growing at under 1%. The currency is suffering severe weakness. So when we translate that into pounds, we're not getting the return on investment that we're looking for. So even though Barclays has a fairly solid operating business or Absa has a fairly solid operating business in South Africa, they reported results just the other day. They reported double-digit growth. They're reporting, non-performing loans are not increasing despite the tough economic environment. So there is an improving profit profile from Absa. So it is fundamentally a sound business. It's just simply a discussion of, well, we expected a 13% return on equity from the South African business. It's not meeting that target. We've got to have capital. We have capital requirements and capital issues. We've got to ensure our bank is well capitalized, or our shareholders the stock market's going to punish us badly and we may have a run on the bank. So, our 62.5% stake in the South African business, which we don't see necessarily attractive top-line growth for the time being, even though it's very profitable. It seems an easy avenue to raise revenue. You know, we can raise £3.5 billion from selling this investment, and we can shore up our balance sheet in the meanwhile and take care of any capital adequacy requirements. So I don't think it's necessarily a vote of no confidence in the South African economy, or a vote of profitability and the future of the economy is dire. Yes, we know the economy is slow, but it's more around issues surrounding the parent company and very weak currency, resulting in diminished return on equity for the parent company because the pound has been so strong.
Everything that we've spoken about speaks to confidence, right? Besides the performance of the economy. Now, the word that I've heard repeatedly being mentioned is that of confidence. The minister is on a roadshow currently, accompanied by Mr. Zweli Mkhize and other officials. What is the point of this roadshow then?
Well, exactly to your point, Tim. It's to shore up confidence in the South African economy. We know that National Treasury have announced a number of expenditure cuts, a number of measures to raise revenue, so whether it was the increase in capital gains tax, whether it was an increase in the property transfer duties, whether it was a reduction in the allowance for fiscal drag. So yes, there was no increase in the marginal income tax rate, but in order to cater completely for fiscal drag, meaning people's salaries being adjusted for inflation, government would have to cater for around just under 20 billion rand. They've only catered 5.5 billion rand for fiscal drag. So in actual fact, they are going to be collecting more taxes through income taxes simply because of the fiscal drag effect. So it's about ensuring international investors that the South African National Treasury, the South African government, is doing sufficiently enough to cut wasteful expenditure, to raise enough amount of revenue. And we all hear in the media about the 30 billion rand hole which needs to be filled. And it's about National Treasury instilling confidence in investors in our fixed income markets that that hole is going to be filled, that we're going to raise enough revenue and we're going to cut enough wasteful expenditure or non-productive expenditure in terms of economic growth to ensure that, not only are we going to fill that 30 billion rand hole, but we're also supporting inclusive economic growth, which over the long term is the only sustainable solution to employment creation and raising more revenues and ensuring the South African economy is on a sustainable trajectory. So it's all about confidence.
Briefly, for a viewer at home who might have investments in pensions or shares or whatever, what does all of this mean? If you can work it back to the individual briefly, what should they be thinking about currently?
Well, at 27.4, we're certainly using these opportunities with all the volatility around to taking risk off the table. And what we mean by that is, we're trading our portfolios very, very actively. So we know that the bond market, the yields have come down sort of 100 basis points in the last 6 weeks or so. We're using that opportunity to lock in profits in the bond market. We're saying, there's this threat of the ratings downgrade looming over us. There's all this execution risk. There's the threat of the US increasing interest rates, the US Federal Reserve. So there's all these risks out there. It no longer makes sense to allocate capital or a significant portion of capital to the long end of the bond market. We'd rather be more conservative. Money market NCDs giving you 8% guarantee, almost guaranteed over 1 year. If the banks go bankrupt and you don't get that 8%, well, you have a lot more to worry about than your money market investments. That's structurally shaking the foundations of the South African economy. So we're certainly using this opportunity to take some risk off the table. Cutting our bond exposure, increasing our cash exposure. With regards to our equities investments, we're still sticking to companies which we know can deliver sustainable earnings growth. We think that the commodity companies are still in a bit of trouble, given that, commodity prices are still fairly depressed, even though they're off their lows, which we saw in the fourth quarter of last year. Commodity prices still fairly depressed. We know there's a lot of restructuring issues around those companies. So in our allocation across all our funds to equities, we're remaining more positive on companies which can generate sustainable earnings growth, but at the same time ensuring we're not paying up too much for that earnings growth. So I think the bottom line here, the theme is that diversification. We're maximizing our diversification benefits in terms of our offshore allocation, in terms of where we're allocating money locally, but then also de-risking the portfolios and being more smart about how we get our inflation-beating returns.
Thank you very much, Nadir. Much appreciated.
It's a pleasure.
And of course, we paid him a visit here on Money Moves. So we're talking from Nadir's offices. He's with 27.4 We Live Investments. You can get in touch with them, and the number 011-442-2454, or visit the website www.274.com. Much appreciated. That's Money Moves, and our focus this evening being on the possible downgrade rating, and generally to educate, inform ourselves about how the rating system works and what the implications thereof are, and of course the issues that you must consider when it comes to protecting your own financial affairs in the context of the current times. So we continue with the program in a moment.